On today's episode of the Stock Market Playbook, we've got Steven Fiorillo. You're not going to want to miss this. This guy is the ultimate contrarian of contrarians. He talks about something that I think everybody is missing. This is a great episode. See what he thinks about the Mag 7. See what he thinks about the Fantastic Six. See what he thinks about AI and some of the hidden gems out there that nobody's looking at. Steve Fiorillo is going to blow your mind. I hope you enjoy the episode. Here it is. Okay, Steven, thank you for joining us today. We're glad to have you joining us from New York, snowed in, but recovering, not freezing to death. Is this correct?
You can keep your snow over there, okay?
Listen, coming from a Utah snow guy, happy to skip a winter. Happy, but I know you guys have been getting pounded pretty good. So glad to have you on with us this morning.
I
I always wondered,
appreciate it.
does the internet signal freeze? Can that happen? Can Wi-Fi be frozen in midair? I don't know.
We've been very lucky, although I had my first malfunction 2 nights ago, and I think I'm gonna get Starlink as a backup. For no reason other than, God forbid something happens in the winter, I have it.
Don't I actually know a couple of people who have done that, added Starlink as a backup. And funny enough, a couple of those people have said, I actually just canceled my other one because Starlink is like so good, so reliable, so fast. It's wild. I love the technology that we have available now. My childhood was drinking out of hoses and, riding a bike till it was dark at night, and now we are absolutely living in the future, and it's awesome.
Yeah, those days are long gone.
They are very much long gone. Well, Stephen, we're happy to have you on with us. And I think there's a lot of exciting things happening in the market right now. And we're excited to hear your point of view. I know you've got a lot of great experience in this space, a lot of great angles that you're looking at. So we're excited to hear all about it. For my viewers that are seeing you for the first time, if that's possible, people know you. So for that one person that doesn't know you, give us a little bit of a background. Where are you coming from? How did you get here?
Ah, interesting. So, from New York, I have been writing on Seeking Alpha since 2018, I guess, that
Nice.
area. I've been on a lot of different podcasts, mainly Emit, and then started going on Tanner's. And then they convinced me, along with my wife, to start my own YouTube channel. And then Emit and I started our in person Basis Points podcast, and episode 3 will be coming out tomorrow. So, kind of been in the writing game for a long time, more newer to the actual video content.
Well, so far so good. And your Basis Point podcast, I think, is kind of exploding. Is that safe to say?
Yeah, I guess so. I mean, I think it's doing good. Josh Brown was incredible for the first guest. Dan Ives
Yeah.
was incredible for the second, and the third guest is going to be another banger. So it's going to be good.
Yeah, you guys are knocking it out of the park. I think everybody has to have Dan Ives on because A, he's smart, he's been in the industry forever, and B, his style is just wild. The guy always is wearing the craziest, coolest stuff, and I love it.
Yeah, super intelligent. And I think he's got the right beat on a lot of things. When you're in the industry for that long and you've covered tech for that long, you gain a lot of experience. I happen to agree with pretty much everything he is saying. I mean, I don't know if you saw it. Made a probably 12 or 1400 word post last night. I don't understand the bear thesis around AI. I just don't understand it. It doesn't make any sense.
I mean, you might as well walk up to the plate and just hit it out of the park. So the bear thesis on AI. I mean, let's unpack that a little bit. There's obviously there's so much on both sides. My fellow hedge funders, I think, are all over the place. A topic. So tell me what you think about this. A lot of my guests that have been on here, and a lot of my, fellow hedge funders that I chat with on a regular basis, everyone's kind of leaning into this. Okay, AI is overcooked, and too much money has gone into it, and really the big benefactors are going to be, the content companies that arise from the ashes after the AI stocks get crushed. So, not saying that's my point of view, but that's what I'm hearing so much. So where give me your take on all of that.
So I'm on the opposite side of it. And I don't run a hedge fund. Every opinion is my own opinion and my own money. I'm not running anybody else's money. So take everything I say with a grain of salt. Okay. And also, just because I believe something doesn't mean it's correct or that it's going to come true. So certainly don't make any decisions based off of what I say. But I have a very strong opinion on this because I am very data driven. And the data supports that this is the next computing evolution. And when you actually go through and really look at the data and using Apple as the baseline, because they are the ones that have not spent aggressively on CapEx. Here are the raw numbers. Apple, and we're going to use fiscal years because these companies do not report on calendar years. So Apple, as you know, Q3 is their Q4, Microsoft, normal Q2 is their Q4. So when I am
Yeah.
talking about numbers, I'm talking about the 2021 fiscal year for the two of them, in addition to Amazon, Alphabet, and Meta. And then I'm going to talk about the TTM for wherever they finished in the December quarter. So Apple's CapEx has gone from 11.1 to $12.2 billion over that time frame. Their CapEx has grown by 9.5%. Microsoft, over the same period, has grown their CapEx by 303% to the tune of 83 billion. Okay. Amazon has grown their CapEx over the same period 115%. Alphabet 271%, Meta 273%. Why is this important? It's important because it's going to show us the more that these companies invest in themselves, the
Mhm.
more their profitability scales. Apple was the only one out of these companies in the 2021 fiscal year that was generating over $100 billion of cash from operations. The only one. Since the 2021 fiscal year, their cash from operations has grown by 30.21%. They've added 31.43 billion in cash from operations. Microsoft's cash from operations has grown by 109% from 76 to $160 billion. They now generate more cash from operations than Apple. Alphabet, 164 billion now. Their cash from operations has grown 79%. Amazon's has grown 201%, and Meta's 100.1%. So there's a direct correlation between allocating toward CapEx and explosive cash from operations growth. And if we go down to the EBITDA line, which I don't really like doing, but for this instance, I'll knock out two stats. Microsoft has grown their EBITDA over the same period 117%. They're now doing 175 billion. Alphabet has grown 68.5% to over 150 billion. So Apple's EBITDA 27%. There's to me a direct correlation. And the numbers on the cash flow statement does not lie. Like, unless we're going to say that their auditors who have to be the top four, it's either Deloitte, Price Waterhouse, KPMG, or EY, I would think. I don't know who they are, but if I had to make a speculation, I would speculate it's one of the big four that all these companies are using.
Sure.
And I'm seeing the monetization, and everybody is now freaking out because Bloomberg's data is saying that Amazon is likely to generate negative $500 million in free cash flow for 2026 because they are going to allocate 200 billion to CapEx. What people aren't talking about, and I cited this last night, well, that doesn't make sense. That should be great because they only generate 139 billion only in 2025. So that means that their cash from operations has to grow by $60 billion year over year to lose or generate negative 500 million in free cash flow for 2026. What other
Right.
companies are monetizing their assets to that degree, there's only 5 companies that can even compete in this space at this point. And all this capital that's being spent, no other companies are able to, unless you consider Oracle, which they're the 5th, in my opinion. We've seen it with Cisco. We've seen it with IBM. Their hyperclouds aren't growing really. They're not able to compete at this level. There's no other companies that can come in. So if AI really is the future, where we're hearing from all the CEOs and we're seeing the compute, we see what NVIDIA dropped on their Q4 earnings, which is the craziest earnings call and earnings numbers I've ever seen from a company that I've looked at. I just think that the bears are being very short-sighted and focusing on a year or two, not 5 or 10 years out, and how much these companies are going to monetize their assets.
I think it's an interesting point that Apple, first of all, has this reputation of of always saying, "Hey, we're not going to be first, but we're going to do it better." Right? That's kind of what Apple has tried to do, and it's a super interesting point you bring up because there's an obvious correlation there of what what you just demonstrated, and then there's like this other weird picture that the stock market itself is portraying. Right? You've got all the big guys that are spending like crazy that are 20% off highs. Their stocks are getting murdered, right? And then Apple has kind of stayed steady. It's kind of hung in there, and Apple went from kind of getting punished because they have no. And full disclosure, I'm an iPhone guy. We're on a Mac right now, but right. And so they were getting punished for saying, you guys have no AI plan. Apple is now going to use Gemini to power Siri, right? They're so behind the curve, and they're getting punished, and everyone's saying time to shake up the upper management. Let's get the C-suite out. These guys are totally out of touch with everything. To now this narrative of maybe Apple had it right, maybe they were careful and slow to spend, and maybe that's good. And the stock is just nobody kind of knows what to do with Apple right now, right? Because there's an obvious lag that they have. They have no AI. They just don't, right? And their plan is let's buy somebody else, let's rent somebody else. So your idea is there will be too much catch up when it matters, and traders are being too short-sighted right now about where they think the next 5 years goes.
Yeah, I mean, I love Apple, and in full disclosure, I am a direct shareholder of NVIDIA, Meta, Amazon, Microsoft, Alphabet, and Apple. I'm a direct shareholder in all of them. So I'm not trying to make a point that I think Apple's an inferior company. That's certainly not the point. It's just a direct correlation with the numbers. My
Yeah.
fear with Apple is the market is looking at them as they haven't had to deploy all the capex. They've been able to plow into buybacks, which allowed them to juice the EPS in the years that they had negative revenue growth. Now they're back to revenue growth and they have significantly less shares. And maybe they can get away with spending 10 or 20 billion a year and piggybacking off of somebody else. That's certainly one strategy, but I don't think that this is the realm that you want to be doing that, because now you're beheld to either Alphabet or OpenAI, or I mean, I guess it's just one of those two, probably more Alphabet because you have the data centers also. So you have to wait for them to build. And then from a product standpoint, if I'm Alphabet, not saying that this would happen, but why am I going to make Siri better than whatever their assistant is?
Right.
Like, I don't want to be beheld to my competitor.
Right. Right. It's such a. And on a total side note tangent, it's such a funny relationship that Google and Apple have always had. They just, Apple's now saying, we'll just lease Gemini for $1 billion a year, all the while Apple's paying, or Google's paying Apple $20 billion a year to be their search engine,
Search.
right? And
Yep.
and it's this ridiculous thing, but these are, I don't think people are talking about the numbers. At least I don't hear it as often that you brought up. And I think that's a super interesting point, that correlation between, okay, CapEx and how much money are we pumping out of this thing, right? Because the only thing anybody's talking about is how much capex they are spending, right? These companies are putting tons of money out there, and nobody's really correlating that, or at least it's not in the general narrative as much with growth, right? It's just you're putting out endless amounts of money. This is a huge bubble, blah blah blah. Every comparison to .com related stuff, and that's it.
Man, I should put
But
my Apple Watch on because when I hear somebody say, I'm not saying that you believe this, but just the whole idea of correlation to .com just drives me nuts.
it
Drives me
it
nuts.
it is pretty funny, and it's interesting because I mean, I was thinking about this the other day, and I use a lot of different, AI platforms, Claude and Open, Chat GPT and Gemini and all of them, right? They all have their different things that are cool about them and so on. But if you think about it, I mean, .com, right? We're coming up with all this internet stuff, and if anybody, which I'm sure most people remember using a computer in 2000, using a computer in the late 90s, generally worthless, right? You could chat with somebody on whatever messenger, and websites were there was just not much going on. Versus this AI space that has come in now. And I was just thinking the other day, I said to myself, AI has just made this endless amount of information that we have on the internet useful, which is like significant, right? Not to mention the things that it can do with coding and all the incredible amount of busy work that it takes away and makes more efficient. But I'm definitely on the side with you that probably we're just scratching the surface in the usability and the utilization of all of this. And so would you say your thesis of the Bears, they've got it wrong, and this is fantastic opportunity, let's say Mag 7. I mean, are you buying dips on these guys? Like
You couldn't have set me up better for what I'm about to hit share on. And this is not planned. So I'm not sure
let's
if you've ever
go.
seen me share this before. Now, these are not my numbers, okay? And the way that I phrase this is current year because Microsoft and Apple do not report on a calendar year. Nvidia does not report on a calendar year, even though they should. Ending their year in like the middle of January makes no sense because 90%, 95% of their data is actually 2025 numbers. So the fact that they just reported their fiscal year 26 to me is broken. I wish everybody just report on a calendar year, but be that as it may, current year for EPS, next year, following year. So theoretically 26, 27, 28.
Hmm.
These estimates are all the streets estimates that I pulled off of Seeking Alpha. Okay. NVIDIA right now is trading at 22 times 26 earnings. They're expected to increase EPS from the end of 26 through 28 by 58.23%. And they're trading at less than 14 times forward earnings. I have never seen, and I can't recall 2022. I'm going to have to go back to some of my articles that I wrote and see if I can pull one of these tables. I have never seen Alphabet, Microsoft, Amazon, Meta, and Nvidia trade at less than 20 times forward earnings that I can recall. It definitely is possible, but I just can't recall it. I think that these companies are so cheap right now, especially the lowest forward growth rate is 32.06% EPS over the next 2 years. And that's from Meta. The fact that these companies are trading like this, and Apple's the one getting a premium. And I think that Apple is trading where it is because of their kind of a lax stance on CapEx. And then you look at Walmart and Costco, and I put a huge piece out on this. It drives me even more crazy that they're getting these types of multiples when the Mag 7 X Tesla, which I now call the Spectacular 6, are not. And here's why. If, and I have a whole deck I can present if you want, if Walmart and Costco are being looked at as sticky revenue because everybody has to buy groceries, everybody has to buy household supplies, et cetera, et cetera. Let's actually look at the data. and if I recall correctly, which I'm pretty sure I'm about to, every single year, Amazon has added more revenue on a yearly basis than Costco and Walmart. Every year except for 1 year, they had a larger growth rate than both companies. Only 1 year did Costco have a larger growth rate on a year-over-year basis. And going forward, Amazon is expected to grow its revenue by double-digit percent, while Walmart and Costco are expected to grow between 5 to 8% year-over-year for the next 3 years. Now, Amazon sells everything that they sell for the most part, and they deliver right to your door. And they generate more revenue than both of them, and they're expected to be the first $1 trillion revenue company. And they have AWS, and they have an advertising platform that just did 21.5 billion in revenue in Q4. That is going to be on a run rate of roughly 100 billion in 2026. So how Amazon's revenue is not considered as sticky is crazy to me because enterprises are not getting off of AWS. Nobody is
Right.
stopping buying on Amazon. There's only trucks I see in New York City delivering packages. Yet Amazon's trading at less than 20 times forward and less than 30 times this year when Walmart and Costco traded over between 40 to 50 times. And they have less than 30% EPS growth over the next 2 years. So do I think it's a great time? For me, yes. And I am buying the dip.
So, I mean, when you look at the numbers like this, it feels a little bit like, and if I can borrow a political term, do we have some Mag 7 derangement syndrome happening potentially?
I think so.
Everybody's saying the run has been too big. They've they've eh, they've they've enjoyed their hyped move and it's over and everybody's facing this harsh reality. And now the bulls have totally gone to the bear side and everybody's kind of waiting for the big mothership of all corrections and they're ignoring. I mean, how often does this happen though on Wall Street? I would say just on a daily basis, maybe that that it gets that hype and and depression are overkilled on both sides. So that it's super interesting because I don't think I have talked to certainly any recent guests on the podcast and colleagues in the industry that are bullish Mag 7. It's I think you're making an argument that is much more rare than, and I'm sure you hear the kickback on this, but it's much more rare than I think people realize. I'm kind of blown away because you can't argue with the numbers. It makes sense. And I always ask all of my guests, what's the Mag 7 doing? What is this dead money? What's the deal? And so you're the first to say, buy it with both hands and both feet, like jump in.
Well, I'm saying that I am buying the dip. I'm not saying
Right.
anybody
You're not
should.
making recommendations, and we're not
I'm
making
just saying
recommendations,
that
but
when I look at the numbers and people want to make whatever excuse or look at whatever, I'm looking at the actual numbers. I'm sure everybody else is. 2 people, 4 people, 10 people can look at the same thing and all have a different opinion, which is fine. That's what makes a
yeah,
market. But long-term fundamentals is what wins at the end of the day. Do we
for
think
sure.
that companies are leaving the Microsoft environment? Do we really think that? And SaaS is another thing I've been going crazy about because the idea that you're going to vibe code an enterprise level software product that's going to replace CrowdStrike or replace Salesforce or replace ServiceNow is one of the dumbest things I've ever heard. And the reason I say it like that is because you have to understand the way business works. Just because a bunch of 20 and 25-year-olds enter the workplace and they're vibe coding, they have all these tools and they're building things, doesn't mean the C-suite is going to stake their careers on getting rid of one of these enterprise level platforms when the contract expires and have something that 3 people coded in the IT room to replace that. It just, the decision process doesn't work like that. And then when you think about enterprise resource planning, Workdays, Oracle PeopleSoft, Microsoft Dynamics, SAP, I've worked at very large companies. Now, you cannot run a large company without ERP software. Your HR department, your fiscal department, your learning and talent development, your payroll, you have to do that out of a real platform. There is too much compliance risk not to do it. So it just that whole thing didn't make sense. And we're tying it back to the Mag 7. Who's competing with these companies? So we're gonna bet against arguably the greatest CEOs collectively ever in the history of humanity. When you think about Nadella, Jassy slash Bezos, Zuckerberg, Sundar, we're going to bet against these guys. Why? They've built multi-trillion dollar companies. They're controlling the balance sheets of the largest companies. They are all generating over 100 billion in cash from operations. I'm willing to put my personal money behind them that they may know something about something rather than somebody that's never worked at those companies, never worked in the industry, and has an opinion because in their mind, the stock is too high. These are the same people that thought the Dow was too high at 10,000, that thought the Dow was too high at 20,000, that hated it at 30 and 40 and are screaming at 50. And they're going to be crying at 60 and 70. So GDP continues to expand, corporate earnings continue to expand, revenue continues to expand. Why are we going to think that these companies collectively are just going to go away? Why? Because WorldCom had a scam? Why? Because Enron had a scam? I mean, there's no evidence or data that these companies are going to stop growing. And riddle me this, who controls all the data centers? Oh, it's three companies: Amazon, Alphabet, Microsoft. Have fun getting off of that.
It's a good point, and in making that point, you bring up obviously the next hot topic, which is all the SaaS companies, right? And how everybody is jumping ship on those like crazy. And I think that's a great argument. I think one of my favorite, totally misunderstood examples recently is Block. Right, we're laying off half of our
Yeah.
workforce, and we think AI can do a great job. And then about 9 million, profiles and posts on X saying these guys are the same size as everyone else that has half the workforce. They're just poorly managed, right? And so so that whole thing ran out of steam really quick. But it's it's definitely interesting about enterprise level everything. So is your stance that, I mean, are these enterprise level SaaS companies going to, in whatever form, just become more efficient with AI? Are they going to become more profitable with AI? Are they going to be able to keep their workforce? I mean, I think it's a safe assumption that they're not just going to be replaced because somebody has Claude.
Yeah, it's a great question. And I'm probably on the opposite of a lot of people on this. There's going to be winners and losers. I think there's going to be some companies that get disrupted. I think there are going to be some companies that lose revenue because they're not able to sell as many seats, because I do believe the workforce is going to change significantly in the future, whether it's the next 3 to 5 or 5 to 10 years. I don't have a crystal ball. I can't predict a time frame, but I do think AI is going to change the workforce dramatically. Now, that doesn't mean that every one of these companies is going to go away, but I do think there's going to be small companies that come out of nowhere that become big companies. That always happens, any environment. But if we're going to talk about the big ones, which is where I focus, I don't know if you can run IT departments without ServiceNow. I mean, certainly some do, but ServiceNow is a great company. They make it very hard to leave their platform. You look at Salesforce. Benioff gave everybody guidance out to 2030. Why are we doubting what he just said? He just implemented a $50 billion buyback program. Why does that not matter to anybody? I mean, if we bring up Salesforce's actual numbers, and it's ripping today, and I put a post out maybe 30 minutes ago saying the Dow was down 950, the NASDAQ was down 200, S&P was down 90, yet Salesforce is up 4.5, and ServiceNow is up 6.5%. And when I look at Salesforce, and I have the numbers somewhere else, 178 billion market cap, not accounting for what it's up today. But you look at their financials and you look at their cash flow statement. And I swear to God, I feel like more people need to start reading cash flow statements more closely, because when you actually look at this, this does not read like a company that's in trouble. So in the trailing 12, they just reported their fiscal year. Oh, they did 14.4 billion in free cash flow. Hey, think about that number, 14.4 billion in free cash flow. Every year since going back to 2019, their cash from operations has increased year over year. They just added roughly 1.9 billion in cash from operations. And then we look at their buybacks. They're buying back, they just bought back $13 billion worth of shares. The year before that, 7.8 billion. I mean, they bought back more in shares last year than a lot of companies generate in revenue. This is a company that people want to be bearish on. I mean, come on. To me, it doesn't make sense. And they're paying a small dividend. I think Salesforce, it was criminal under 200. And I think that people have this idea that they use Salesforce and they don't like the product, which is fine. You don't have to like the product. What matters is what your head of IT and your C-suite think, because they're the ones that are going to make the decision if Wet Ink goes on a contract or not. And if companies aren't getting rid of these platforms, everybody's opinion of if the product is good or not doesn't matter. And if you actually look at the underlying data, they're scaling their AI efforts. And I do think there'll be a transition from the amount of seats that they're selling to how many agents companies are leasing, or whatever the correct terminology is going to be, and how much the net dollar retention and how much they scale their AI. I think you'll see a shift in the revenue mix, but Salesforce is not a company that I think Amazon and these other companies are going to be able to get rid of. I just don't.
That's a perfect segue into kind of my next thought, which Salesforce is a great example. You know, Salesforce was the darling, everybody hated them, back and forth. The numbers have been solid all along, right? They're kind of victims a little bit of the fear and the hype and everything in the middle. Who do you think is I mean, what are some companies that you're looking at right now that you think will, we've talked Mag 7, we've talked CRM. Who, who, what am I trying to say? Who do you think will get hit the most from this
Ugh.
expansion in AI?
I have one, and it's something people are going to hate for me to say.
Oh, we love it. I mean, you've been contrarian of contrarian this whole time, so we're ready for it. Let's go.
There's one company that I have mixed feelings about, and it's because I don't use their products enough. And I am not, look, I follow a lot of different companies. I personally don't use their products. It's a very good company, very well known company. Out of all the big ones, Adobe is the one that I would not feel as confident as I feel for Salesforce and ServiceNow, only because I can't come to a conclusion in my mind as to if individuals or smaller corporations will replace Adobe's Premiere product with AI tools from a Claude or a Gemini or something like that. I just don't know. It's an unknown. And obviously, Adobe's going to build in their own AI and whatnot. From a numbers standpoint, it looks like the biggest screaming buy out of all of SaaS, right next to Salesforce. I just have a harder time believing Salesforce is going to get disrupted rather than Adobe. And I could be wrong on that, but Adobe's the one I'm actually not buying right now.
That's interesting because a lot of other people aren't either. They're Adobe's getting pretty hammered. I mean, I'm just looking right this moment, 56% off highs. That's significant. That's
Yeah.
significant. Adobe's just been getting smashed all along the way. And it is interesting because Adobe is in this space where, and I don't know Adobe's business that well. And I also don't, I'm not heavy in their products, but that's a space ripe for disruption, right? I mean, they're basically going directly up against AI. What do? We do a lot of things with video and visual and so on. And that's just AI is aggressive in that space.
Yeah, it's why I just can't. It looks like one of the best value deals. I just can't get there, only because the future's too uncertain. I'm not opposed to taking a risk and betting on something that I think will happen, but there's just too many ways I can see it getting not completely disrupted, but disrupted enough where growth slows and the market just keeps it at a very certain multiple. And for that reason, I'm just so much more bullish on Salesforce.
Interesting. Interesting. These are some really great takes. It's I love doing this show because I get people like you that look at things so differently, but it makes so much sense what you're saying. In kind of a final thought, who is nobody suspecting out there? Do you have a name that you think these guys either will be huge benefactors from AI or they're so I mean, obviously the Mag 7 have all their attributes. Who's a total sneaker? Who's a diamond in the rough?
Man, I got something that I've been buying. A lot of people have been telling me I'm crazy. A lot of people don't see it. And the stock over the past, and in full disclosure, I started a position at about $20 or $20.15. And I said, I have no idea what this is going to do. It's either I'm going to buy it up to 25 or I'm going to buy it down to 15 because in the short term, I have no clue what's going to happen. I think it's become a very big company. So the stock has, since I bought it, well, I got two for you. I'm going to give you two. So the first one I'm talking about is an AI play. And it's gone from it started going up when I first started the position. It ran to about 24 and a half, and then it cratered to right around 15, and now it's back to 1880. Zeta Global,
Hmm.
ticker Zeta. A lot of people don't understand the company. A lot of people want nothing to do with it because it's advertising and customer retention data. The numbers are so good for a small company, and this is what I've been saying to people. It's a $4.5 billion company. When I look at the revenue, this thing is not trading the way that a company that has its fundamentals should be. They just flipped profitability. It reminds me of where Palantir was back when I started covering Palantir. It really does. And I'm choosing my words very carefully. That was the pause there. So I've seen companies trade for 10, 20, 30 billion pre-revenue or companies that lose money with minimal revenue because of the idea of what they can become. Two classic ones right now are SMR and Oklo.
Hmm.
So, I mean, Oklo loses money, they have no revenue. Yet the last time I checked, they were a $10.5 billion company. And they were at one point 2030 billion. So my thing is Zeta, $4.5 billion company, if they trade at 12 billion, that's a 3x. What would be the thing to stop them? On a revenue standpoint, they just grew revenue from 728 million in 23 to a billion in 24, and they just exceeded earnings, I believe, for the 20th quarter and 1.3 billion. The street is expecting 1.76 billion this year, growth accelerating to 34.5% year over year. On a non-GAAP basis, they're expected to do 95 cents in EPS. That puts them at 19.7 times this year's earnings. And this company, the CEO openly is talking that they are taking customers away from the trade desk. They're servicing 51%, I believe, of the Fortune 100 companies. And their metrics are only scaling in the correct direction. So I think it's something to really look at and watch.
A sleeper,
Yeah,
and
out of
and
nowhere.
I'm just looking at this chart right now, and I mean these guys to top it all off decide to go public in the middle of 21
Yeah.
when and they actually survived decently well through 22. They had a little hit, uh but then goes basically parabolic beginning of 24. And interesting. This is I love these sleepers. I haven't I Zeta has not been on my radar. I haven't heard of it, seen it, anything. So that's a great one.
Yeah, I
I'm
mean,
gonna I'm
I'm
gonna keep
just
my eye.
gonna pull some numbers for you. 16 straight quarters of 20% plus revenue growth. 20 consecutive quarters of expanding adjusted EBITDA margins. Now, I hate adjusted EBITDA, but a bunch of companies report on it. I wish we could just stick. Another thing drives me crazy. Like Palantir, I'm a shareholder. I've been covering them since the direct listing. You don't need to say adjusted free cash flow. You do enough. You don't need to put adjusted. Just shoot the damn free cash flow. Anyway, adjusted EBITDA growth year over year in Q4 was 35%. Revenue growth in Q4, 25%. So there's a lot of things to like. They have 19 consecutive quarters of sequential scaled customer expansion. There's just a lot of things that are going right with this company. And one of the biggest things that I like about them, when you look at operating income, negative operating income from 2019 to 2024. They just finished 2025, $28.8 million of operating income. If this continues scaling the way that it looks, it's only going to be up and to the right and improve the fundamentals and valuation. I want to get in companies before everybody else knows and before everybody else cares about them. And this is something that's going the right way. It's got a great balance sheet, 319 million in cash. The long-term debt is only 197 million, so cash-rich company, profitable, free cash flow, profitable for many years. They're now doing 185 million free cash flow. And Dan Ives interviewed the CEO at CES, and I listened to the interview, and there was something the CEO said that stuck with me. He walked into the boardroom when they were a private company back in 2017, I believe he said. They had just done $50 million in EBITDA. And he said, we're going to make no money for the next 3 years. I'm redeploying 400 engineers. We're overhauling everything. We're going to be an AI focused company, AI first company. Back then, pre 2020, what CEO slash founder walks into their boardroom, other than a handful of them, saying, yeah, the 50 million of EBITDA that we just got to, yet none for the next 3 years. We're redefining ourselves. That's somebody I want to invest in.
Right, right. Talk about being ahead of the curve. 2017. I mean, who was talking
Yeah.
AI then, right? Interesting. Okay, I love it. I love it. It's on
I
my
got one more for you that's outside of tech,
yeah. Oh, a non-tech? Let's hear
non-tech.
it.
Okay. Have you ever heard of Brad Jacobs?
Yes. Yeah.
Okay. QXO is my
Yep.
pick. All right. So,
QXO.
so XPO Logistics, United Rentals, United Waste. This guy is a legend in business. He's done over 500 M&A deals throughout his career. You look at what he's done with those three companies I just named, he's scaled all of them through acquisitions. QXO is probably going to be his last hurrah, and he is looking to redefine the building distribution sector. He just made his second acquisition. The first one was Beacon Roofing, $12 billion acquisition, just made another one, and it's supposedly one of six or one of seven that they're going to do. He is looking to build this company out. I believe they're using Palantir Foundry for the back end. I, I can't find the data right now. I do believe that they are using that. So somebody can fact check me on that. And I'll admit if I'm wrong. I'm pretty sure they are. And he is going at this with a goal of scaling this to $50 billion in revenue annually through acquisitions and through overhauling the back end, making efficiencies, et cetera, et cetera. At one times revenue, that's a 50 billion market cap. The market cap right now for QXO, and I wrote an article about them when I think they were trading around 16 or so. Their market cap is 16.5 billion. So if it trades a one-time revenue and he does what he says he's going to do, that's a three bagger right there. and you have several tailwinds. We got rates coming down. I think we're getting 3 or 4 rate cuts this year. We may not. We may only get 2, but I can't see that. We're probably gonna have rate cuts next year. What's that gonna do? That's gonna unlock the housing market. That's gonna make cost of capital less. What happens when cost of capital is less? Oh, people do home renovations. People put a deck outside. Oh, people decide, well, my 3% that I've been holding on to for so long that I've wanted to sell for the past 5 years. Okay, 4% mortgage, sure. We'll trade up at this point. I think the housing market gets unlocked over the next 2 to 3 years. And I think that as rates come down, you're going to have the home builders build more homes because we need more homes. The cost of capital will allow the unit of economics to do so. And QXO is going to be a de facto winner in the space.
That one is wild, and I love that. And just a plug for our good buddy Brad Jacobs. I had never heard of the guy until about maybe a year ago, and I came across his book, right? How to Make a
Mhm.
Few Billion Dollars. And then he just came out with a sequel, How to Make a Few More Billion Dollars. And I thought, this guy's how is this guy worth 15 billion and I've never heard of him, right? And then he just has this wildly no nonsense approach to just expanding these businesses in a aggressive way. I think that is a great recommendation, or a great one to watch. That's a really great one to watch. I love that.
Yeah, it's a sleeper. It's not a sexy industry. It's not something that's in the news, but I like betting on winners. And Brad Jacobs is a winner and he knows what he's doing. He's got a great track record. To think he's not going to be able to do what he's going to do. And look, his goal is to consolidate the 800 billion building distribution products, and he's going to use M&A to do it. So we'll see. I really like them. I mean, Morgan Stanley, they have an overweight rating at 28 price target. And they do think, if I remember correctly, that they're going to get to 50 billion revenue.
That one's great. And also transportation, building, distribution, materials. These are all
It's
you know,
anti-tech.
they're the anti-tech. These are the safe spots, right? You're not going to get replaced by AI, And
Right.
so that's a super great industry to watch, and that's a great stock. Brad Jacobs, yeah, what a story that is. So that's awesome. Those are some great insights you have. I have immensely enjoyed this discussion with you. So thanks again for joining us today. Obviously, my viewers are going to be stoked about all the things you're saying. So we know you're with Seeking Alpha. Where is that the best place for people to follow you? Give us your X profile. How do
Yeah.
people keep
So
track?
my X profile is at Steven Fiorillo, and you can follow me on YouTube. I go live every night, and I go live in the evenings. So I think the content that we put out is really, really interesting. And co-host of Basis Points, we're on episode 3, and I'm not going to say who the next guest is tomorrow, March 6th at 5 or 5:30. The next episode will come out. It is a CEO of a major company, and it is not a CEO that has been um, doing a lot of podcasts, I would say. So there's one in my mind that people that follow me know that's been doing a lot of podcasts on the circuit. It's not that one. Comes out tomorrow. It's going to be a banger. We talked about a lot of interesting things. So Basis Points, my YouTube channel, and Seeking Alpha and X.
Excellent, excellent. And we will post all the links as well
Thank you.
below this. But looking forward to kind of following the journey, and I would love to have you on again in the future. This was a awesome discussion. So thanks for being with us. Thanks for sharing your thoughts. It's a lot to digest, but that's great stuff. So thanks again, Stephen. Thanks for being on, and we will keep track and stay in touch.
Thank you. Have a great day.
Thank you.